For decades, one tax rule quietly made long-term investing in Australia dramatically more profitable. Buy an asset, hold it long enough, sell it later, and generally only half the capital gain became taxable. That rule helped shape modern Australian investing. Property, shares, ETFs, family trusts, retirement planning, long-term wealth creation. But in the 2026 federal budget, the government announced a major proposal to change how capital gains and negative gearing work in Australia. From 1st July 2027, if the legislation passes, the 50% capital gains tax discount would be replaced for most assets with cost-based indexation and a 30% minimum tax framework on real capital gains. This is not law yet. It is an official budget proposal, but it still needs to pass Parliament before taking effect. This video is general information only. It is not financial, legal, or tax advice. But if these proposals are legislated broadly in their current form, they could reshape how Australians think about investment property, ETFs, trusts, superannuation, and long-term wealth over the next decade. So what exactly is changing? Who is affected? Who is protected? And why are accountants, investors, and property owners suddenly paying very close attention to July 1st, 2027? Why this matters. This is not just another technical tax adjustment hidden inside a budget paper. It potentially changes the incentive structure behind long-term investing in Australia. Under the current system, strong capital growth is rewarded heavily. The larger your investment gain becomes over time, the more valuable the 50% CGT discount becomes. But under the proposed framework, that relationship changes. Instead of automatically discounting half the gain, the tax system would adjust the original cost base for inflation. In plain English, the government is proposing to tax more of the real gain, not the inflation component. That means assets growing slowly and roughly tracking inflation may not be heavily affected, but high-growth assets, especially long-held investment property, shares, ETFs, and some trust structures, could face very different tax outcomes over time. And importantly, not every investor is affected in the same way. Existing negatively geared property owners would generally be grandfathered. Superannuation funds would continue under separate CGT rules. Some income support recipients, including age pension and job seeker recipients, would be exempt from the proposed 30% minimum tax on capital gains. And small business CGT concessions are expected to remain unchanged. So this is not a simple story of everyone pays more tax. The real story is more specific. Your outcome depends on what you own, when you bought it, how it is structured, and whether the final legislation passes in its current form. How the proposed CGT system works. Let's simplify the mechanics first. Imagine you buy an asset for $100,000. Years later, you sell it for $200,000. Under the current system, the capital gain is $100,000. Because the asset was held longer than 12 months, the 50% CGT discount would generally apply. So only $50,000 gets added to your taxable income. Under the proposed framework, for most assets, the flat 50% discount would be replaced with cost-based indexation. That means the original purchase price is adjusted upward for inflation. Using a simplified example, and assuming average annual inflation of around 2.5% over the holding period, a $100,000 purchase price might be indexed upward to approximately $115,000. And importantly, the higher inflation is while you hold the asset, the larger that indexation adjustment becomes. So if the asset is later sold for $200,000, the taxable capital gain is calculated like this: $200,000 sale price minus $115,000 indexed cost base equals $85,000 taxable capital gain. That is the key difference. Under the current discount model, the taxable gain might be $50,000. Under the proposed indexation model, in this simplified example, the taxable gain is around $85,000. But be clear, that does not mean paying $85,000 in tax. It means $85,000 becomes the amount exposed to tax, depending on marginal tax rates, ownership structure, proposed minimum tax rules, exemptions, and final legislation. Now let's move from a small example to a real-world property example. Imagine a Sydney investment property purchased for $700,000 and later sold for $1.5 million after a long holding period. Under the current system, the capital gain is $800,000. With the existing 50% CGT discount, approximately $400,000 would typically become taxable income. Under the proposed indexation model, the calculation changes. Using a simplified illustrative example, assuming average inflation of around 2.5% annually over a 10-year holding period, the original $700,000 cost base might be indexed upward to approximately $895,000. So the calculation becomes $1.5 million sale price minus $895,000 indexed cost base equals approximately $605,000 taxable capital gain. So in this example, current system, around $400,000 taxable. Proposed indexation system, around $605,000 taxable. That is roughly $205,000 more exposed to tax. Again, this is not a tax bill. It is not saying the investor pays $605,000 in tax. It is showing how much of the gain may become taxable under this simplified model before the final tax outcome is calculated. That final outcome would depend on income, ownership structure, exemptions, and final legislation. But this is why the proposal matters. For high-growth assets, the difference between a flat 50% discount and inflation indexation can become very significant. And that is only the first layer. Because the budget proposal does not just change how the gain is calculated, it also introduces a proposed 30% minimum tax framework that can affect how the remaining gain is taxed. The proposed indexation system and the proposed 30% minimum tax are two separate mechanisms. First, indexation adjusts the cost base and reduces the nominal gain. Then, the proposed minimum tax acts as a floor on the tax rate applied to that remaining real gain. In practice, this mainly matters where an investor would otherwise realize the gain in a year when the effective tax rate on that gain falls below 30%. For example, during retirement when other income may be lower. If the gain is already taxed at an effective rate above 30%, the minimum tax may not change the outcome. However, budget materials also state that certain income support recipients, including age pension and job seeker recipients, would be exempt from the minimum tax if they receive a payment in the financial year they realize the gain. So again, the impact depends heavily on individual circumstances. The 1st of July 2027 transition. If you own an asset today and still hold it past July 1st, 2027, one date could become extremely important. The market value of that asset on July 1st, 2027. That value may become the line separating gains taxed under the old system from gains taxed under the proposed new system. Here is why. According to the budget materials, the CGT changes would only apply to gains arising after 1st July 2027. So gains before that date would generally keep the existing treatment. In plain English, the tax system needs a way to separate gains built up before July 1st, 2027 from gains built up after it. For assets already owned before the start date, taxpayers would be able to either seek a valuation as at 1st July 2027 or use a specified apportionment formula. The ATO is expected to provide tools to help estimate that value. That means record keeping around the transition date may become important for investors holding property, shares, businesses, or long-term family assets. And for some families and long-term business owners, the next part of the proposal may be one of the most significant changes in the entire budget announcement. Because the reforms do not stop at new investments, they also affect assets that historically sat outside the capital gains tax system entirely. Assets acquired before September 20th, 1985 are commonly known as pre-CGT assets. Historically, these assets have remained outside the CGT regime. But under the budget proposal, gains on pre-CGT assets that accrue after July 1st, 2027 would enter the CGT system moving forward. Gains accumulated before that date would remain exempt. The proposed transition would use the asset's market value at July 1st, 2027 as the new starting point for calculating future gains. That means long-held family property, private business assets, shares, or legacy investments may need much closer attention if the legislation proceeds. And importantly, the current small business CGT concessions, including the 15-year exemption, active asset concessions, retirement exemption, and rollover, are expected to continue unchanged under the current proposal. Again, these are budget proposals, not enacted law. The final rules still depend on legislation passing Parliament. Now that we have covered how the proposed CGT system is designed to work, the next question is more practical. Who is actually affected? Because property investors, ETF investors, superannuation funds, trust holders, and small business owners are not all treated the same way. In Part 2, we break down exactly who is protected, who may be affected, and which dates matter most. I'm Clear Sense AU. Subscribe so you do not miss Part 2, where we cover property, ETFs, super, trusts, and the negative gearing changes